Hi, I'm Peter Rose, founder of Longwood Currency Trading. Why you should keep track of your Forex trades. The process of trading just isn't segmented into, oh, I'm going to sit down and trade today, hit bid ask, and I win money or I lose money. In trading, as I'm sure you're aware, there are certain metrics that you can collect about your trading that tells you how you're doing. What you hear a lot is this risk to reward ratio. I'm going to risk 1, but I'm going to try to make 3. That doesn't make any sense at all. It's not practical. The only thing you can be sure of is you're going to risk 1, but you can't be sure that you're going to make 3. So to say that you're trading for some reward based on some risk is ludicrous, because that has nothing to do with the market or your ability to be successful within that market. And how would you know that? Because that ratio doesn't persist into the future. It doesn't tell you anything. I'm going to be a 3-to-1 risk to reward, which is wrong. You don't say risk to reward, you say reward to risk, because everybody always states it. I'm going to win 3 for every 1 I risk. So you're a 3. Instead of a 1 to 3, which is a 0.33. Oh my God, some of these people that are out there that are telling you stuff just don't know what they're doing. So risk to reward is not a metric. What could be a metric? Well, your win to loss ratio, the number of wins divided by the number of your losses. That tells you something. And it gives you some predictive capability to say, oh, I'm in a 6, I've lost 6 trades in a row. That's just a statistical anomaly. I'll have the same ability to win 6 trades in a row. But in the aggregate, my win to loss ratio is 60-40. I win 60 trades for every 40, or I win 6 trades for every 4 out of 10, however you want to think about it. It's all got to add up to 100% when you put the 2 percentages together. When you are looking at win-to-loss ratio, for example, that is a metric, because given enough data, given enough trades, you can say with more confidence that you will win 6 out of 10 trades. If you only trade for a week, or let's say 2 weeks, that'll give you 10 trading days, basically, right? So you say, oh, I'm an 80-20 trader. Over the last 10 days, I've won 8 and I've lost 2. And then you go on with that supposition over the next 2 weeks, and all of a sudden you're upside down, you're a 30% winner and 70% loser. It's because the skill that you have isn't predictable, it's probabilistic. So when you have a larger number of trades to go by, then you have a better ability at judging what the next set are going to be. If you go through 100 trades and you develop your metrics, and then you look at the next 100 trades that you're going to do, you could say, well, I've got a pretty good idea of how those other 100 trades should come out. I got a 60-40 ratio with the first 100, so I should have pretty close to 60-40 on the next 100. If you end up on the next 100 without blending the 2 together, and you're 70-30, you go, wow, I must have improved something, because I've improved my win-to-loss ratio substantially. Or if you're below 60-40, you say, well, wait a minute, I'm constantly doing something wrong. What am I doing wrong? I mean, the win-to-loss ratio isn't the only one you need. I use 4 particular ratios that I keep track of. But what gives you the ability to keep track of this data? You have to keep track of the trades. You have to keep track of every transaction that you make. You say, oh, I can look that up in my broker statement. Yeah, you can, but you're also looking at all the clutter of all the orders you've placed and all the cancel orders and financing charges and all the rest of the crap that they clutter up with the broker report. So unless you know how to load all that stuff into an Excel spreadsheet, take out the rows that aren't needed and sort them correctly, you're not really going to understand the data that you have. You've got all the data, but you've got too much data. See, that's the thing that I talk about all the time, is that doesn't make things simple when you have too much of anything. Too many rules, too many whatever. So you have too much data in your broker report. That's why you have to take the time to figure out which data elements you need to keep track of in order to develop the metrics that you've chosen to develop, like the win-to-loss ratio. What data elements, what data do you need in order to calculate the win-to-loss ratio? And quite frankly, if all you're looking at is win-to-loss ratio, you're not helping yourself. You need other metrics in order to support that, and also in order to use it to do other things than just say, oh, I'm a 60-40 trader. Because who gives a shit? 60-40 trader. And in order to do this, you have to understand trading, which it comes right back to learn trading first. Don't learn somebody's system in the London Open or engulfing candle pattern or whatever it is that that's not trading. That's being a monkey, just mimicking what somebody else does. You don't want to mimic what somebody else does. What somebody else does and they're teaching, that's a system. I don't teach systems. I make you think. I teach methodologies and I teach process-oriented trading using the methodology. Well, what's the difference? Well, the difference is it's damn sure not along engulfing candle patterns and golden crosses and the rest of the crap, and particularly fibs. You look at the process of trading. What are you trying to accomplish? What's the market conditions like as you're doing that trading? What's the volatility? What currency pair are you trading with, and how does the price action today compare with what it did yesterday and 5 days ago? How do you work into some kind of a probabilistic analysis of your trading within the probabilistic analysis that you do against the market that you're trading? I mean, those are the things that you have to do, and it's simple to do that, but you have to have the correct data. And in order to have the correct data, you have to know what it is, and then you have to keep track of it. And the way that you keep track of it is important for your ability just to look at the data and say, oh, I've got this going on, as opposed to just having a bunch of data like your broker report and going, holy crap, what do I do with this? So I would encourage you, regardless of your experience level, you could have 5 years of trading experience and not really have been exposed to the importance of not only knowing that the data is being collected for you in a broker report, but you need to collect that data individually as you're going along so that you have a running snapshot of every trade as to how you're doing for the week or the month or the day. If you're scalping, you're going to want to keep track of all those transactions during the day to see how you've done over the aggregate, the last 10 days of trading that you've done, that you've scalped. When you are an active trader, you're collecting more data, therefore you can make better probabilistic estimates of what you're going to be capable of doing, and you're also then going to be able to develop expectation metrics that will guide you like a stoplight. It starts to turn it goes from green and it turns orange. That's a warning sign. Hey, if you're racing up to this light, it's going to be red and you're going to go through it. You're going to hit somebody or you'll get arrested or whatever. So by keeping daily transaction records in the beginning until you get used to what's going on, I've been trading for a long time and been involved in the currency markets and studying them since 2007. So I mean, I don't keep transactional data, I base my data on daily results. I look at my starting balance and I look at my ending balance and I write that down and create the metrics for that particular day. And when I'm doing well, 80% of the days I'm profitable. And you could say, well, that's fine. What do you do on the other 2 days? Well, sometimes I lose far more than what I've made. That's just part of the game. But in the aggregate over the long period of time, as far as winning and losing days for valuation, you need to know that value. But then you also need to know other metrics in order to make sure that, I win 80% of my trades, but you're still losing money. What other metrics are you tracking so that you understand why you're losing the money? Where is that happening? And you can look in your broker report and you can go blind trying to figure that out. So I'm just saying to you that the title of the video is why you should keep track of your Forex trades. That's it. I can't tell you any more than that. Although when I'm working with somebody in my coursework, I give them a little recipe for them to keep track of their transactional data, and then later on to expand that into keeping track of daily data, how the two processes correlate together, and how you begin to develop metrics based on all-in, all-out trading. And then as you begin to build and stage into positions when you're doing larger lot size trading, how those metrics change and how you determine then the differential between the changed metrics that you had versus the metrics when you were trading all in, all out. Is that a good thing or is that a bad thing? And how do you track that? What metric do you track in order to do that? And so that's all part of the 4 metrics that I calculate. A couple of those metrics, they're not needed until after a large number of trades have been done, so that you can look at that number and say, oh, okay, that's changed. So how did that change in relationship to the average over the longer period of time? And is that a good thing or is that a bad thing? So that's why you should keep track of your Forex trades other than and outside of your broker report statement. There's too much information there. You won't know what to do with it. You won't know how to get in there and extract the data that you need. And even if you do, it's going to take you too long. So you might as well do it yourself. It doesn't take that long. When I was keeping track of the transactional data, it just took me, 10 seconds after the transaction was closed to record. I bought it here, I had sold it here, I made this much, this many lots, this is the time of day I took the trade. I mean, what more do you need? Well, there are other data elements that you are going to calculate, but you get the main data down when you're doing the transactional recording. You don't calculate the metric itself. You just copy out the data. You just write out the data, and then at the end of the day, you go through each closed position and you calculate the metrics and you see how you've done for the day. As opposed to what I do, which is just look at the beginning number and the ending number, go, oh, yeah, I made some money today. Well, what percentage of my overall average risk was that? How did I do today in relationship to how I should be doing according to my long-term metrics? So keep track of your Forex trades on a transactional basis. And when you get ready to do it on a daily basis, that's fine. If you're starting out or you don't have any experience, let's say you've got 5 years of trading, but you don't have any experience in record keeping and data keeping, don't just make the assumption that your daily data tracking is going to be sufficient for you, because it's not going to help you one bit. I'm just telling you that from working with a lot of people that think they know they're going to be okay, and they end up not being so okay. And I've got ways that we go and we prove that to the person, so they go, oh shit, I guess you're right, maybe I better do X, Y, Z. Well, that's great, but we've been 3 weeks into this thing and you haven't been doing what I've asked you to do. So you need to make a decision if you're going to do what I asked you to do, or maybe this isn't going to work, because I don't have time to waste on folks that are not interested in building a solid base of knowledge, so that they can then learn how to do process-oriented trading against a methodology, and you need to keep track of your Forex trades in order to be able to develop the processes that are going to drive the methodologies that you're trading against. If you don't have that data, if you don't have that data turned into valid metrics, then you're going to have a really hard time doing process-oriented trading. You'll be relegated to signal services engulfing candle patterns, head and shoulders patterns, and Fibonacci's. Oh my. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.